Let's start with the big picture. What does the market setup look like heading into the second half of 2026? Now, markets are facing a familiar wall of worry: geopolitical conflict, oil prices, inflation, Fed policy, and of course, questions around the durability of the AI-led rally. But the economic backdrop still looks resilient. Growth remains solid, inflation has come down substantially from its peak, unemployment is reasonable, and importantly, market leadership appears to be broadening. In short, the soft landing still looks intact. Now, earlier this year, markets were pricing in potential Fed cuts. Now, the front end of the yield curve points more toward the possibility of rate hikes. But importantly, 10-year Treasury yields remain in check, suggesting that long-term inflation expectations appear contained. Now, amidst this soft economic landing, equity market performance has broadened, with the equal weight S&P 500 and equal weight NASDAQ 100 outperforming their market cap-weighted siblings. Small and mid-cap stocks have outperformed as well. Take that soft economic landing and a broadening equity market, and that suggests a twist on the recently passed Alan Greenspan's famous phrase: today's market may be showing signs of rational exuberance. And that's a useful perspective as we dig further into opportunity for equities.
Equity markets in 2026 have largely centered around two questions. Can the AI-fueled growth stock rally continue? And can markets keep shrugging off macro uncertainty? So far, we can definitively answer yes to both. But such a narrow focus misses a broader perspective on the market that has important implications. The second half of the year may be shaped by two trends that are outside of the headlines: broader participation and higher dispersion between the market's winners and losers. While surging hyperscaler CapEx spending seems likely to keep the AI narrative in focus for the near term, other segments of the market have assumed leadership. Mid and small cap stocks are a great example. They have outperformed the S&P 500, not just on a year-to-date basis, but dating back to April of 2025. This strength is well supported by the fundamentals. Earnings growth expectations have also broadened beyond the largest tech names, with low to mid-teens growth expected for smaller stocks and companies outside of the Mag 7. That matters because broader participation has historically been associated with sustainable bull markets, rather than one concentrated in just a few names. Given this backdrop, we see attractive opportunities for investors to diversify their portfolios. Investors should seek income that is not correlated with interest rates, like daily covered call strategies. Second, consider companies with disciplined capital management policies, like consistent buybacks and dividend growth. And finally, consider factor-specific strategies like momentum that have the potential to continue to outperform the broad benchmarks. That broader market backdrop also matters for bonds, where investors may need to think differently about credit and income.
Credit markets have been surprisingly resilient in 2026, even with the geopolitical conflict and the software sell-off earlier in the year. Spreads widened briefly near the end of the first quarter, but they returned to their historically tight levels quickly. For bond investors, that means the opportunity may be less about further price gains and more about the income being earned from coupons. But investors may also need to consider that we could be moving into a later stage of the cycle. Growth has been running above trend, while unemployment has moved closer to its estimated natural rate, a setup that may point to a late cycle environment. In this type of environment, credit can still deliver stable returns, but it may underperform other asset classes from a multi-asset perspective. At the same time, AI is creating unique opportunities in the debt market, especially as hyperscalers turn to bond issuance to fund the AI infrastructure build-out. That makes fixed income a more selective story. Income still matters, but investors may need to look beyond broad credit exposure to find the most compelling opportunities.